Hey everyone, and welcome back. I hope everyone's having a great week. It's election week in the United States, and at the time of recording this, I have no idea what the result will be, but when you're seeing this, you probably will. So whatever that is, I hope some people out there are happy. I know there'll be some people who are disappointed, but with all of that said, the most important thing happening this week is, of course, my stock market Q&A video for the month of November 2020. So I won't waste too much of your time with a long introduction. If you enjoy it, leave a like, let me know your thoughts down in the comment section below. But with that said, let's jump into the first question. The first question that we've got here is generally selling above intrinsic value is correct. Let's assume that we identify intrinsic value. How much above the intrinsic value should an investor think of selling at least part of his investment? Yeah, so I think that's a really excellent question. I talk quite a lot about buying businesses below intrinsic value. And when I say that, what I'm really saying is I project the future cash flows of the business that I think are reasonable to expect. And then I discount them at my target return. So I can figure out what price to pay based on the long-term return that I want to make. And I talk quite a lot about that, but I don't talk a lot about selling. And generally speaking, you're going to get different opinions on this. Some people will believe that, if a stock goes up 100%, you should be selling that stock, or, a lot of people will have different benchmarks. But for me, I'm generally a buy and hold. So I'm trying to accumulate and stockpile, I think Phil Town calls it, as much stock in a company that I like over time. And generally speaking, I'm only looking to sell if the long-term expected return is really, really low. So what do I mean by that? When I'm investing in a company, as I said, I'm projecting future cash flows. And when I'm investing in a company, I'm discounting those cash flows using a discounted cash flow formula at about 22%. That's what I'm targeting in a best case. So I'm, in other words, targeting a business that can be purchased and deliver me 22% compounded returns in terms of the cash flows in the future. So when it comes to selling, I use the exact same process, but kind of the other way around, right? So if I'm wanting to buy businesses when the expected return is really high, when I can make a 22% return, I would want to be selling when the expected return is very, very low. So for me, I use a 5% required rate of return. So in other words, if a business in the discounted cash flow has a lower expected long-term return than 5%, if I think I'm going to make less than 5% per year on that stock over its remaining life, then I'm starting to sell out of that business. But that doesn't happen very often for the businesses that I'm looking at. In fact, it's never happened for any of the businesses that are major positions in my portfolio. And just to give you a little bit of a real life example of this, one of the businesses in my portfolio that has done really, really well is Corporate Travel Management. Now, that stock at the moment sits at about $16. My average price in that stock is about $6. So it's gone up substantially. But if that business in my discounted cash flow was to have an expected return of 5%, then the buy price, so in other words, the price I would be looking to sell corporate travel at, would be around $50 to $60 per share. So it's got a long way to go. It would need to go up, somewhere between 8 to 10 times on my initial investment in order for me to start selling out of that business. So it looks like, for the most part, I'm going to be trying to accumulate wealth in businesses that I like and probably not selling them under most circumstances. The next question that we've got here is, would you ever sell put options on investments in the near future? And would you create a video going through Warren Buffett's strategy of selling out of options on long-term investments? Yeah, so in terms of selling put options, it's one of the ways that Phil Town talks about generating some cash flow from your investments while they are not yet at a price where you would be ready to invest in those businesses. It's not something I currently do, so that's why I haven't spoken about it. It would be a little bit weird if I spoke about something that I hadn't practiced myself, but it may be something that I try at some point in the future. Options are not something that's sort of easily available or widely available, I should say, for Australian businesses, but it is for US businesses. So, and since I do have quite a few businesses business investments in the US, it very well likely may be something I try and look into at some point in the future. But as it currently stands, it's not something that I have done, and as a result, won't be something that I will talk about on the channel. The next question that we've got here is, hi Hamish, I wanted to ask about growth stocks. Consider we found a good growth company with potential in the future. How do we calculate fair price where we buy this stock? Essentially, how do we price a growth stock? Yeah, so we price a growth stock in the same way that we price any other stock. We're estimating reasonably what we can expect to get out of the business in the future, coming up with a reasonable expectation of future cash flows. What do we think is highly likely to occur out of that business? And for slow growing companies or no growing companies, the future cash flows are going to look very similar to the past cash flows. The only difference with a growth company is that the future cash flows are likely going to be higher than the past cash flow. So you're going to need to be projecting that the business grows versus a business that isn't growing. You're probably going to be projecting that it continues to not grow, or maybe it grows at a very, very small rate. And if you're looking for a calculator that can help you navigate that, then I highly recommend you download my free stock analysis spreadsheet. It's always linked in the description of all of my YouTube videos. As I said, it's completely free, and you will be able to use that to come up with a projection of future cash flows. And as a result of that, you'll be able to figure out what is an appropriate price to pay, assuming that you've done your research and that you deeply understand the business to the point where you can reasonably estimate the future cash flows of the business. And one other thing to mention is that for some businesses, you just can't estimate the future cash flows. For me personally, that's most businesses. I have a very small select window of businesses, a small group of businesses that I've looked into very, very deeply. And I feel very confident when I'm approaching analyzing them and figuring out what their future cash flows are. But for most businesses, and especially for unprofitable businesses or businesses that are brand new to the stock market or have just recently been founded, I don't even attempt to try and estimate the future cash flows. The next question that we've got here is, hi Hamish, I've been watching your videos for about a month now. Well, welcome aboard, and I hope that you've gotten some value out of them. I really like your channel, and you make investments in stocks so much easier to understand and doable for the general public. Just wondering, where do you get your free data for long-term debt? I find that they are always missing. Also, any substitute name for the same thing. What does long-term debt include? Yeah, so you got a few questions there. I get most of my long-term data initially from quickfs.net. I'll leave the link to the website down in the description below. It's free. You do need to make an account, but you can access 10 years of financial data for free. And then you can sign up to a paid plan if you want to access 20 or 30 years of financial data. But that's where I initially get my data for long-term debt and all of the other data from the financial statements. But essentially, you can never rely on these third-party websites to have correct data all the time. So what you would then want to do is go to the official website for the company, look at the investor relations page, and within that investor relations page, you will be able to find the annual reports, which will have the official balance sheets, and within those official balance sheets will be the long-term debt numbers. And you are also correct that there are a number of different ways that a company will describe long-term debt. The most common other one that I've seen is borrowings. So long-term debt, short-term debt, borrowings. Those are kind of the main ways that it will be described. I can't think of any others off the top of my head, but there are some other ways as well, I'm sure, that it gets described. So you just need to look at the balance sheet, look in the liability section, and then maybe just do a quick Google search of all of the different terms in there so that you can identify what is debt and what are just other types of obligations. The next question that we've got here is what stocks are currently paying YouTubers or offering to pay YouTubers to advertise? Yeah, that's a really strange thing that's happened recently. A few YouTubers well, some of them got caught out, but others were just blatantly being paid to basically make a stock review video for a company whose name is defeating me, a vegan company. And I won't name any channels, but yeah, it's a strange world where you have a public company that's worth $200 or $300 million. They made $1 million or something in the quarter in revenue, so their stock price is highly inflated. It would not be a good investment for the average person who didn't know what they were doing by any means. It certainly brings into question integrity when you're getting paid by the company to make a stock review. That is what it is. But if you're interested in a video covering that specifically, check out Sven Carlin's channel. He did a video going into it. I think it's called The Very Good Company or Very Good Meats Company or something. Man, I'm going to look it up one sec. The Very Good Food Company Incorporated. That's the company that has been paying YouTubers to do review videos. So if you're wondering why there's been a ton of people covering that stock recently, there's your answer. But Sven did a great video covering that. I highly recommend you check it out. He actually analyzes the business and points out some major flaws in the business itself. So I highly recommend you check that out. The next question that we've got here is, hi Hamish, do you use a checklist in your investments? Why do you prefer to, okay, so there's a couple of different questions here. Do I use a checklist? I mean, I don't have an official checklist, but I do go through a checklist. I just kind of do it in my head because I've done it so many times with so many businesses. But if you follow along with any of my stock analysis videos, which should serve as case studies, you can see some of the major things that I tick off when I'm going through an analysis. Things like looking at the debt ratios, looking at the return on invested capital, making sure that the business has a distinct advantage. So looking at their growth in revenue, their growth in profits, their growth in equity. Those are some of the things that are on my checklist. I don't have a piece of paper that has, boxes and I tick them off every time I'm analyzing a company, but I kind of do that in my head. So I guess I really kind of do have a checklist. And then your second question was, why do you prefer to calculate return on invested capital based on owner's cash flow rather than based on free cash flow or net income? Yeah, so in terms of net income, well, first of all, I like to use a cash flow figure instead of net income because I want to look at the real cash coming in and out of the business, whereas the net income figure is a paper profit. Right? It includes non-cash expenses like depreciation. If a business has a building, they are able to have an expense that is the building depreciating over time, losing value because it's getting older. So that means that profit figure can have some non-cash income and some non-cash expenses that the business didn't actually receive or pay out in cash during that period. So I want to look at cash. That's the first thing. And then the reason why I look at owner's earnings, or I call it cash flow for owners, instead of free cash flow, is simply that free cash flow excludes all of the capital expenditures, whereas owner's earnings only excludes the maintenance capital expenditures, the money spent on maintaining assets. Because I believe that if a business spends money on assets that will grow the value of the business, that is another form of management delivering cash to me. Right? It's not cash that is coming directly to me, but it's being reinvested to build new restaurants or something like that. And then the business, through building those new restaurants, can generate more cash flow, and the value of the business will go up and the stock price should go up with it. So in that way, those cash flows are still being returned to me in one form or another. It's not coming to me directly as a dividend, but it is coming to me in the form of the business becoming more valuable. And then the last question that we have time for here today is, do you see Intel staying behind AMD and Nvidia? Is Intel a good investment right now? I wish I knew the answer to that question. A lot of people are looking at Intel at the moment. Sven, again, I'll mention him. He's done a really good analysis on the company, but I don't know. And the reason why I don't know is because it's outside my circle of competence. It's in an industry that I don't know enough about to feel confident that I can have clarity or a clear vision of which businesses are going to be thriving in the future in that industry and what the future cash flows of those businesses will be. So as attractive as it looks on a PE basis, or how many other people are saying it's a good investment right now, I can't look at it, or I don't want to look at it, because I don't understand the business. And if I was to try, then I would probably end up making a bad decision. And I only want to make decisions where I'm very, very confident that I'm going to make a substantial amount of money. And that means I stick to areas that I deeply understand. So that is all we had time for today. I hope you guys enjoyed the video. And if you're wondering how you can get a question in next month's video, what you need to do is first be subscribed, hit that notification bell next to the subscription button and turn on all notifications. And then basically in 4 weeks time, in about a month's time, I will be making a post on my community board. That's on my YouTube channel. There's a community board tab where I can post things and let you know what's going on. On that board, I'll be posting a question letting you know I'm looking for Q&A for the month of December. That'll be next month's video. And if you're subscribed, if you have notifications turned on, then you will be notified when that post comes out, and you can leave your questions there. But other than that, hope you guys enjoyed today's video, and I'll see you in the next video.